Well, hello, everyone. Happy to have today's webinar where we'll be covering the Biden administration's tax proposals and 5 key things to know. I'm Nick Breit, Principal and Director of Financial Planning at Fiducient Advisors. Happy to be joined today by Debbie Denno, a partner with Federman, Lally Remis.
Thank you, Nick. Welcome, everyone.
On today's webinar, we'll be covering what proposals were included and perhaps just as importantly, what was left out. We'll assess the odds of some of these proposals actually being drafted into legislation. We'll review the narrow path to passing legislation. We'll look at the possible timeline for implementing some of these tax changes. And then we'll close with practical considerations for taxpayers. And then at the end of today's presentation, we'll reserve some time for questions and answers. If you have questions as we go through the presentation, I'd encourage you to type those questions up into the chat box. We'll answer as many of those as we can at the tail end of today's presentation. So let's jump right into it. The American Families Plan. In late April, President Biden unveiled the $1.8 trillion American Families Plan, really aimed at helping working and middle-class families. Now, the proposal outlines about $1.5 trillion in tax increases from high-income taxpayers that would fund much of the current proposals. And before we jump into exactly what the proposals are, I think it's helpful to just quickly outline where exactly these dollars would be allocated. So the first segment would be towards education, about $500 billion of the proposal, about $200 billion specifically targeted towards free universal pre-kindergarten for all 3- and 4-year-olds. Then there's about $500 billion allocated for families and children, increasing availability for affordable, high-quality childcare, as well as a national paid family and medical leave program. And then about $855 billion, or roughly half of the proposal, dedicated to expanded tax credits. So with that as background, Debbie, I think it'd be helpful for us just to jump right in and go through some of the included proposals, specifically the individual income tax rates and capital gains taxes.
Sure, Nick. So as Nick just reviewed, those are some of the benefits of the American Families Plan. And obviously, they have a cost, which needs to be paid for by additional revenues. So it's also important to note that these are just proposals. These are not what's going to actually happen. It's really basically the president's wish list right now, which the House and the Senate Finance Committee will use going forward to figure out what they want to do and haggle over it and as they come to an agreement. Some of the key items that were in these proposals that have people a little bit anxious are this top one is the increase in the individual tax rates. And it's key to note, so it'll be back to the top tax rate, 39.6%, up from 37%. But besides the rate increase, it's also key to note that there is also a bracket compression. You'll see that for married filing jointly, the top tax rate kicks in at $628,300. Under these proposals, increasing the tax rate to 39.6% would actually kick in at $509,300 for married filing joint. And you can see the rest of them in the table that's provided in the slide. Another big one that people are very anxious about, and it's basically due to the what the effective date would be, is the increase in long-term capital gains rates. So President Biden's proposal calls for an increase in capital gains and qualified dividends to the ordinary income rate, which a top tax rate of 39.6%. And as some of you may or may not know in your returns, there's a net investment income tax that's tacked on to capital gains and qualified dividends, and that's 3.8%. So if this increase were to go into play, it would be really a 43.4% tax rate versus the now current 23.8%. And as I mentioned, the biggest question is, what is the effective date? It has referenced an effective date as being the announcement date, which was when President Biden issued his proposal, which was April 28th, or is it the date that the Green Book was issued, which is May 28th? Either way, there are deals going on. There are deals that have already happened. We actually have a client in my office. Big client sold their business within days of this announcement, April 28th. They sold within a couple days after. So that would subject them, if it's retroactive, that would subject them to double the tax that we had calculated they would pay. So this is huge. This is very huge for a lot of deals that are pending, because people don't know what to do. They're trying to get clarification as to what that's going to be. And we can go over some tax planning that you might want to consider with your accountant and advisors. As we go through the rest of this year, we'll do that in the closing statements.
And I think it's a helpful reminder. I think some taxpayers might have seen the headlines and think that would broadly apply to all taxpayers. It's an important reminder. This is really targeted for taxpayers with adjusted gross income north of $1 million.
Correct.
Certainly one of the more controversial aspects of the proposal, Debbie, was effectively repealing the step up in cost basis at death, as well as changing the tax treatment on transfers made during one's lifetime, if you want to walk through those.
Right. So this now is, generally any transfers of property by gift or debt or on death will be treated as an income realization event. For example, if a taxpayer dies, typically any of his assets that were transferred over to his heirs were at cost basis. Now what's going to happen, or what the proposal is that it would be brought up to fair market value, and any capital gain that is built in will be recognized on the taxpayer's final tax return. So there would be taxes to pay when there might not even be any cash available. And the same for transfers by gift now, as opposed, instead of the cost basis transferring over, that will create an income realization event to the donor. There are certain exemptions for family-owned businesses and gifts to charity or gifts to your spouse, transfers to your spouse. Again, these are proposals, and obviously the final details will be worked out as we go through the next coming months.
Yeah, I can think of some discussions I've had with clients recently on this second section here, just regarding gifts during their lifetime, where they've really paused on the gifting just till we get greater clarity on whether this gains traction in future legislation. And then rounding out some of the other key proposals here.
Right. So another proposal is expanding the scope of the 3.8% Medicare tax. This is really what we deem as the net investment income tax for people on investment income, but also expanding it, especially for S corporation owners, because currently there is a loophole where their distributive earnings from their businesses that's reported on their K-1 is not subject to self-employment tax. And typically S corporation owner shareholders take a small salary to support the SE tax. But this is probably more likely than some other provisions to definitely survive. It has come up as an issue under the last 3 to 4 presidents. So this might be something that will survive. So we should keep an eye on it. Again, to note, it's only for earnings over 400,000. So if you have a S corp owner who takes $100,000 salary, that's already subject to SE tax. But then if their K-1 shows earnings from their business of 300,000, this would not apply. If it's over 400,000, the amount over 400,000 would be subject to the SE tax. So as it stands right now, the way it's written, there's also this 400,000 gap that will not be subject to it. And then we also have some capital gain treatment for carried interest, long-term capital gain treatments, which would be changing to, again, the ordinary income rates. Magical number again, 400,000. Another key one is the Section 1031 like-kind exchanges for real estate. You may recall the Tax Cuts and Jobs Act eliminated other than real estate like-kind exchanges. So those are no longer available. But now the 1031 like-kind exchanges will be limited to gains of $500,000 per taxpayer or $1 million for married taxpayers. So that can certainly affect people in real estate that are looking to make some transactions happen, after this year. And then, of course, we know the IRS funding is small, and the IRS is definitely understaffed. So they're trying to, come up with some dollars to fund the IRS for greater tax enforcement.
I think just perhaps as helpful as what was included is also a review of some items that were excluded. I think it's fair to say tax experts and taxpayers were fairly surprised of some proposals that didn't make it into the plan that Biden had really campaigned on the run up to the presidential election. So Debbie, if you could walk us through some of those.
Sure. So one thing was the estate and gift tax exemption. Everyone knows it's currently 11.7 million. And with the portability election for a couple, that turns into 23.4 million. And as exemption, that could be given during their lifetimes, or if they have large estates. So President Biden had campaigned bringing those exemptions back down to historic norms, as noted on the slides here, of about 3.5 million to 5 million. So we'll have to see what happens there, or if they decide to put something in to raise the estate tax rate. But this is not something that President Biden included in his proposal. So we'll see what happens when the House and Senate Finance Committee start doing their work. And then he had also campaigned about limit on itemized deductions. This is not something new. We've had this in the past where itemized deductions were limited to 28% of AGI. President Biden had spoken about calling that back again, but for taxpayers earning more than $400,000. So we'll see what happens there. And then, as of course, the Social Security taxes, which I already mentioned for S Corp owners, but also the Social Security tax is capped at $142,800 of wages. And because of the way the Social Security system trust fund is getting depleted, President Biden had spoken about increasing the wage limit. So we'll see what happens there.
Yeah, whether the meter gets effectively turned back on. So some people refer to it to be a donut hole. That first 142,000 taxes would be collected, the meter would effectively shut off, and then it would turn back on uncapped above 400,000. But again, that wasn't included. And then looking at a couple other key items as well.
And then definitely, the SALT deduction. For anyone who lives in a high tax state, this was very important. When the Tax Cuts and Jobs Act was passed at the end of 2017, it limits your state and local taxes to $10,000 on your itemized deductions. And in high tax states, so that includes income taxes and your real estate taxes. So in high tax states, your income taxes alone can be more than $10,000. So this is a big thing. And I don't think anyone has liked it since it was included in the last tax act. So we'll see what happens. I think this is going to be a key point in any negotiations for a new tax bill. There are ways around for some states that have a pass-through entity tax, especially if anyone on this call, or if you have a client on this call that has a single member LLC, there is a way to create a separate LLC entity and get around and get more than $10,000 deduction. So if you want any details on that to discuss with your accountant or advisors, then you can drop me an email that's provided in my information at the beginning of this presentation. And then, of course, we have the wealth tax, which I think it just kind of fell off the radar. So I don't know that is something that will happen.
Yeah, I'd say that's pretty broadly unpopular, but important to note that wasn't included. So now that we've walked through what was included, I think it'd be helpful for those on today's webinar to assess the prospects for some of these tax proposals. So as we've outlined here, I think it's the broad consensus currently is the individual income tax rate likely will go back up to 39.6. That seems pretty likely. Wouldn't you agree, Debbie?
Yes, definitely. I think everyone's of the consensus that's going to happen, and probably an effective date of January 1st, 2022.
Yeah, now on the capital gains and qualified dividend side, it's a much different story. The consensus is that it's very unlikely that the Biden administration gets their proposal of effectively doubling it from 20 to 39.6. Generally, most tax practitioners and experts think that it'll probably settle in a range from 25 to 30%. We have a slide here we'll review shortly just to give some historical perspective. The number that I've seen most commonly cited is 28%, which is just about the midpoint between the current 20% rate and the current top ordinary income rate of 37%.
That's also kind of a magical number with people. It seems like we've had 28% in the past, so I think that's why they settle on it. Also, the AMT rate was 28% at one time. So it seems like a magical number to people that people are comfortable with. So
sure,
I think it's likely if they do the increase, it will be 28%. The question is the effective date. That's the uncertainty at this point.
Certainly the $1 million question. We covered the effective repeal of the step up in cost basis. Again, this would be highly controversial, would break with tax law precedent that dates back to the 1920s. So as we've outlined here, the easier option might be that Congress might instead choose to pursue a change to estate limits. I empathize with any tax practitioners that might have to go on a safari hunt for cost basis if they were entrusted with having to do so, and that just seems like it could really be a logistical nightmare.
Right.
You covered the SALT deduction. Again, I think the interesting thing to note here, not only that you have some Democrats from high tax states that want to revise this, but there's a little bit of a divide in that some progressive Democrats have said, well, hold on, we don't need a full repeal of this deduction because much of that deduction accrues to high income taxpayers. So there's a potential instead of a full repeal that perhaps the cap just gets raised from the current $10,000 limit. And then on the corporate tax side, we went from 35 to 21. The proposal is to raise that back up to 28. Debbie, it seems like 25% is the number that's most commonly cited. I think that aligns with comments that Senator Joe Manchin has made to this point.
Right. I think there's probably going to be an increase. I recently participated in a webinar, and the general consensus, I think the public just thinks that the corporations do not pay enough tax. So I think there's probably going to be some type of increase if they can get it in here.
Okay. Thinking through some of the key questions we've received from clients in the aftermath of these proposals, one has to be, the capital gains tax increase and applying it on a retroactive basis. Debbie covered that, but important to note, there's no historical precedent for a retroactive capital gains tax increase. Now, that doesn't mean that it can't happen, but if we just look at history, typically that hasn't happened. Typically, any capital gains tax increase has been applied as of the date legislation was enacted or applied prospectively. And important to note, it seems to have limited support on Capitol Hill. So you have a number of lawmakers that have said, it's really bad policy, really changes the rules in the middle of the game. At the end of May, you had a number of bank executives testify before lawmakers that it would just create extra anxiety and uncertainty. Goldman Sachs chief executive had noted that it could potentially slow down economic activity. So for all these reasons, I think you might see further pushback on the idea of applying this on a retroactive basis. For some historical perspective, we wanted to give an outline of where the maximum capital gains tax rate has been, as noted here by the red line, versus the maximum individual income tax rate in blue. So you can see, looking over the last 65 years, that typically there's been a pretty significant discount afforded to capital gains relative to the individual income tax rate. Recall that Biden is proposing for top income taxpayers that those rates would be one and the same. So a couple of things jump out. One, there was a 3-year period from 1988 to 1990 where those rates were one and the same. But absent that, there's typically been a pretty significant discount afforded to capital gains. And then the other thing that jumps out at us is the last time we saw capital gains tax rates close to 40%, you'd have to go back to the 1970s. So for that reason, many tax experts think that we'll probably settle in somewhere between a 25 to 30% rate, which is where it's typically been over the last 60 plus years. The other thing to note we've had some questions, well, if capital gains tax rates go up, surely that must be a bad thing for the stock market. And that's not necessarily the case for a couple different reasons. First, there's not a strong historical correlation between capital gains tax rates and subsequent market performance. Second, US equity ownership is only about 25% held within taxable accounts. In contrast, in the 1980s, that figure was as much as 50%. That's really a byproduct of the growth in retirement accounts and foreign investment. So even if these capital gains tax increases went through, it doesn't necessarily translate into widespread selling. And then the third point to note is, would the capital gains tax increase be applied retroactively, in which case taxpayers might have already missed their opportunity to sell, or might it be applied prospectively? So important food for thought. And then finally, on the estate exemption side, Debbie had noted that the Tax Cuts and Jobs Act doubled that base. So we're currently at a very historically favorable level of $11.7 million. So potentially provides a window of opportunity for high net worth individuals that might otherwise have a taxable estate someday to at least think about, does it make sense from a timing perspective to get some assets out of their estate? Important to note as part of this process that there's really some logistical challenges in getting some of this legislation through. So important to note that we're looking at very narrow Democratic majorities in both the House and Senate. So in the House, Democrats have a 219 to 211 edge. In the Senate, it's literally gridlocked 50-50. So Kamala Harris would be the tie-breaking vote. Majority Leader Chuck Schumer had hoped to use the reconciliation process through the Senate to allow to pass bills on a simple majority rather than the typical 60 vote requirement. And in a rather large blow, the Senate parliamentarian recently ruled that that would not be available. So Democrats are likely looking at one more use of the reconciliation process through the September 30th fiscal year end. It remains to be seen, but at least one more use of that. So they have to be rather judicious in their application of the reconciliation process. As far as important dates are concerned, we're coming up on one pretty quickly here. Speaker Pelosi had previously cited July 4th as a target date for the House to pass legislation, uncertain whether or not that'll be the case. Important to note, once the House passes it, it goes to the Senate. Now, the Senate doesn't necessarily have to adopt the House's version. And as Debbie had teed up, it's very likely the Senate Finance Committee would draft its own version, after which a conference committee would be convened to reconcile differences. So that September 30th date is actually approaching pretty quickly when you take into account the upcoming summer recess. So for much of August and for a good portion of September, there's no scheduled legislative sessions. So the clock really is ticking to get some of this legislation through. So with that, Debbie, I think it's helpful just to quickly walk through what are the potential timelines to implement some of these tax changes.
Sure, Nick. So I think based on the calendar and of the sessions that Nick just shared, they're up against some pretty short timelines for some of this legislation. And even if they pass, I mean, we're already in July, even if they pass some legislation by the end of September, to especially the capital gains tax rates, if they were retroactive back to April or May, I think that's insane. It's not good for the economy that's trying to rebound after this pandemic. Transactions and deals actually, generate income and revenue going forward. So it really would put a damper, I think, on any economic activity. I think the most likely scenario is January 1st, 2022 for anything. And that's because too, I mean, even if we go back to the Tax Cuts and Jobs Act, that was actually finally passed, like in the final days of December of 2017. So, I'm sure they are hoping to get everything closed by the end of the fiscal year, but they know they have some time even before year end to finalize some tax legislation. So I think January 1st, 2022 is the most likely scenario, as we've indicated here on the slides. Anything for 2023, I don't think so. I think if they can get the legislation passed by the end of this year, then it will be effective January 1st, 2022. I don't think that they're pushing it out to 2023 is going to effectuate anything positive. So
agreed. That's a helpful walkthrough. Thanks, Debbie.
Sure.
Thinking about practical considerations for taxpayers, The first thing that we would note is don't overreact to the unknown. It goes without saying that no one enjoys paying taxes, but taxpayers really need to be cautious before embarking on major financial decisions based on what may or may not ultimately be part of future tax policy. We can't underscore enough the importance of early coordination. So this is really the time that taxpayers should be coordinating with their accountant and estate planning attorney or investment advisor to assess current or possible future planning opportunities. Taxpayers really need to be nimble and prepared to act based on the shape of negotiations over the coming weeks and months, really to assess whether to move forward on planning opportunities. Debbie, I know that you're having some planning discussions currently with clients. I think it'd be helpful to share some of those thoughts here as we wind down before we pivot over to Q&A.
Sure. So as far as like estate planning or charitable planning, I think because the proposed effective date for those changes to take place is January 1st, 2022, you do still have the rest of this year to make some plans regarding those transfers. And as far as the increase in capital gains, even if it is retroactively applied as of April 28th or May 28th, which we do again think is unlikely, and transactions have already occurred where you have capital gains and your income is over $1 million, there are a couple things you can do. If you've scheduled a deal, as in my case with one of our clients, it's already closed. If there's installments that are part of the deal, you might want to talk to your tax advisor and consider if typically you would make the installment sale election, but perhaps if the capital gains are going to increase in 2022, you might want to not elect the installment method and just pay all of the capital gains this year. Again, if it's retroactive, it's not really going to make a difference because it'll go into place like retroactivity date, but certainly if it's effective January 1st, there's some planning to do there. The other thing is again, if it's effective January 1st, 2022, you can work on harvesting some losses that you might have to offset some of those capital gains. And even enough to, if you're just over the $1 million mark, keep in mind the capital gains as it's written and as a lot of the people who are the experts are reading into it, it's only the capital gains that apply over the $1 million of income. So for example, if you have regular income of 900,000 and then you have capital gains income of 200,000, the way we're reading it is that 100,000 of the capital gains will still be taxed at the 20% rate, but the other 100,000 that flips the taxpayer over the $1 million mark, that would be taxed at the ordinary income rate. That's the way it's reading right now. We'll see what happens when they actually get done haggling over the legislation and actually issue final legislation. Then in general, just income and expenses and the fact that the tax rates will be going up. You know, we always say to our clients, you know, accelerate income into 2021 and defer expenses into 2022. That way your income is taxed at a lower rate and you get more expenses to offset higher tax income next year. But obviously you should work with your tax advisor and do a 2-year projection, 2021, 2022, to see if that actually even makes sense. And I think that's it.
Yeah, that's great insight. And then finally, we just have a bullet point on asset location. So how you divide assets between taxable and tax deferred investment accounts can have a meaningful impact on a portfolio's after tax return. So thoughtful planning should be done there, just given proposed changes to capital gains and qualified dividends. I think these are great examples of the planning discussions that we're currently having with our high net worth clients, and certainly ones that would encourage everyone on today's webinar to be having with their trusted team of advisors. So with that, we're drawing tight on time. So we'll pivot to questions and answers, and we'll go through really some rapid fire here. Really encourage anyone with questions to enter them in the chat box. Yes, the presentation slides will be available via an email that's going to come out with the replay link for today. There's a question here on gains from capital gains. Would that be included in that $1 million amount for adjusted gross income? The answer to that is yes. Capital gains are a component of adjusted gross income. There's a question with regard to if Social Security taxes were increased, how that would affect funding for the trust fund, how many years would it add? That's really an unknown. I think the thing that I will add there is it's estimated the trust fund has sufficient remaining assets to 2031. Unfortunately, Congress usually likes waiting till the 11th hour to act. So we're starting to run out of time, but at some point Congress will act. The other follow-up point to note there is I think a lot of potential Social Security recipients get alarmed by that stat, but the Social Security Administration has noted that they'd be able to pay out 75% of benefits out through 2090, just because there'll still be income tax collection coming in. So it's not as though there's not going to be Social Security benefits going forward in the future. Let's see, I'm just looking through some of these other questions. Debbie, someone asked, what is the likelihood of separating tax rates on qualified dividends from capital gains?
So actually, I think I might know what they're asking here. You can actually, even currently, and we do it for more for investment interest expense, claiming investment interest expense on Schedule A. You can only claim investment interest expense to the extent you have investment income. And capital gains and qualified dividends are not included in that definition of investment income, but you can make an election on your return to treat your qualified dividends as ordinary income. And, you know, it's a little bit of a calculation exercise to figure out what's the benefit. So you can do it for investment interest expense purposes. I'm not sure I've really seen anyone do it for regular tax purposes. But again, the proposal is to change the tax rate on both capital gains and qualified dividends, because qualified dividends are considered like capital gains treatment.
Agreed. There's a question here on charitable gifts. Wait until later in the year to see what happens and perhaps defer to 2022. Your thoughts there, Debbie?
We can certainly wait until we see what happens for charitable gifts. I think because the proposal indicates it would not be effective until January 1st, 2022. The only question is what are you gifting and how long will it take to effectuate that gift as we get closer to the end of the year? So it's really just keeping an eye on what's going on with the tax proposals and what the House and Senate are doing.
And I think it's a function too of how your 2021 income compares to 2022 income, right? So if the top rate goes from 37 to 39.6, you'd prefer to get a 39.6 benefit versus a 37% benefit, provided you're going to continue to be in the top bracket. But you also run the risk of what if Democrats decide to try to apply that 28% limit on itemized deductions, which doesn't seem to be the case for 2021. So that's a really tough balancing act from a timing.
Another point too is that with the TCJA and the SALT deduction limit of $10,000, a lot of high net worth taxpayers ended up becoming standard deduction taxpayers. So your charitable deduction amounts really did not make a difference unless they're significant. So if you have a $10,000 SALT deduction, which is pretty much a given, and you know, if your house is paid off or you don't have mortgage interest, which by the way, that's also limited now to $750,000 of mortgage balance, you really need some significant, if all you have is the SALT deduction, the standard deduction is about $25,000 for a married filing joint. You really need to have more than $15,000 of charitable. So that's something to consider too. Again, it's really working with your tax advisor for this year and next year to see where you might be.
Agreed. Well, thanks everyone for joining today's webinar. Hopefully you found the information extremely helpful. We have additional research and insights available on our website under the Insights tab. Debbie, really want to thank you for the insight you provided on today's webinar.
Thank you, Nick, and thank you everyone for attending.
And if there's follow-up questions, I should add, as always, please feel free to contact any of the professionals at Fiducient Advisors. Thank you.